what's going on, everybody? It's a mentor finance trader. Welcome to my channel. If you're new here, like, share, and subscribe.
I wanted to ask you, man, I really need to watch something over and over again. I'm that kind of learner that wants to watch something again.
Yeah, no, I'm recording.
Okay.
Yeah. So, firstly, you have to understand what is the meaning of smart money concepts. Abbreviation for smart money concept is SMC. So you have to know what is the meaning of smart money concept. So smart money concept is just a simple approach to the market, which is used by the banks and big financial institutions. Smart money concepts is the approach or the technique which is used by the big financial institutions and big banks. Big banks, I'm not talking about any bank. I'm talking about the big banks, the likes of central banks, the likes of JP Morgan. That's the big banks that we're speaking about, and big financial institutions. So this is the strategy which is used by those banks. So when you trade smart money as a retail trader, remember that you are a retail trader when it comes to the foreign market. So when you trade smart money, it's more like you are trading with the institutions as compared to someone who's trading, as compared to someone who's trading price action, as compared to someone who's trading Falcon. You are not a retail trader as compared to other traders, right? So in smart money, we are going to focus on 4 aspects. One, we are going to talk about the technical part, technical analysis. So make sure you ask when you don't understand. Make sure you ask when you don't understand.
Yes.
And then fundamental analysis. And then risk management.
Okay.
So what do you prefer to trade most of the time?
I'm actually more into I'm using DERF, so I'm trading volatility indices.
Or you prefer trading volatility indices?
Yes.
Yeah. So with this strategy, you can trade like everything. If you want to trade Nasdaq, if you want to trade gold, if you want to trade anything in the foreign market, you can trade it using smart money concepts. So mainly focus on like everything. So and then trading psychology. So these are the 4 things that we are going to focus on: technical analysis, and then fundamental analysis, risk management, and then trading psychology. Now, the most important thing in trading is trading psychology, as compared to analyzing the charts, as compared to risk management and fundamental analysis. Trading psychology is the most important thing in trading, because you can know how to analyze the market, but at the end of the day, you can fail to make profits in the foreign market, because Forex, 80% is all about psychology, and then 20% is all about the technicals, the fundamentals, and the execution. So the most important thing in trading is trading psychology. You're fine again.
Yes.
Yeah. So for the first 2 weeks, our main focus is learning how to analyze the market technically. So we are basically focusing on the technical part, learning how to analyze the market using smart money concepts. So the first concept that we are going to tackle is the market structure. So that's our first concept, the market structure. So that's the topic for today, market structure. So that's our topic for today. So under market structure, 1, we are going to talk about the trend. 2, we are going to talk about change of character and break of market structure. And then 3, we are going to talk about expansion and retracement. So that's our topic for today, expansion and retracement. So market structure is one of the topics that are very simple, and it's very important to understand market structure. It's very easy. It's very easy to understand market structure, and it's very important to understand market structure, because each and everything that we are going to do in the chart, it comes from what? it comes from the market structure. If you fail the first step, all your analysis, they are going to be wrong, because the market structure is one thing that gives us the whole overview or the bias of the market. So you have to understand the structure of the market before you can attempt to do anything in the market. So you have to understand this concept. So let's start with the trend. So when you talk about the trend, we have two types of trends in the foreign market. One is the uptrend, and then two is the downtrend. Now, when the price is in uptrend, it's whereby the price is creating a series of higher highs, higher low, higher high, higher low, higher high, higher low, higher high. So this is uptrend. And then for the price which is in a downtrend, is whereby the price is creating a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So this is uptrend, and then this downtrend. Uptrend.
Okay.
When the price is in uptrend, you see by price creating higher highs and then higher lows. That's uptrend. And then when the price is in a downtrend, you will see price creating lower high and then lower lows. That's the difference between these two types of trends. We have only two trends in the market. It's either the price is in uptrend or the price is in a downtrend. Now, keep this in mind. When the price is in uptrend, you only focus in buying opportunities. And then when the price is in downtrend, you only focus on the selling opportunities. Don't try to go against the trend. The trend has to be your friend. When the trend is bullish, look for bullish opportunities. You understand the meaning of bullish, right?
Yes, it's up.
Yeah. So when the price is bullish, only look for buying opportunities. And when the price is bearish, you only look for selling opportunities. And the other thing that is very important is the time frame, because you can't use 1 hour time frame to identify the trend. You can't use 30 minutes time frame to identify the trend. You only use higher time frames to identify the trend. Higher time frames, I'm talking about the 4 hour, I'm talking about the daily, I'm talking about the weekly. So you have to choose between these three time frames. But for me, I prefer to use the daily time frame. I prefer to use the daily time frame to identify my trend. So I get into the daily time frame, look at the market trend, and then when I identify the trend, let's say, for example, the trend is bullish, I know that I'm looking for buying opportunities. And then when the price is bearish, I know that I'm looking for selling opportunities, right? Now let's use gold.
Yes.
Let's use gold as an example. So the first thing that we have to do is to click into higher time frame. Let's use the daily time frame. So this is gold. This is gold in daily time frame. Now, when you look at gold in daily time frame, what can you say? What's the trend?
It looks like an uptrend.
It's an uptrend, and our uptrend starts from here, and then it ends here. That's the uptrend. The reason why we are saying the price is uptrend is because we can see it's clear that the price is creating higher highs and then higher low and then higher high, higher low, higher high,
yes,
higher low, higher high, higher low. Now it's clear that the price is bullish. And the other thing that you have to understand when you talk about the structure, the market structure, is how to select your higher highs and higher lows. You don't focus on the inner structures. You focus mainly on the main structures. These are the inner structures. These are the inner structures. So you only focus on the outer structures, not the inner ones. You focus on the outer structures. The outer structures. So that's how you identify the trend.
Yes.
And then let's look at the scenario that we have here. We have the price which created this high and then it created this low. Now, what's the trend here?
It's a bearish trend.
It's a bearish trend.
It's a downtrend.
If the price is in a downtrend, what are the opportunities that you're looking for?
Selling opportunities.
Selling opportunities. And that's it. That's the most hardest. And it's hard to follow the trend, but it's simple to identify the trend. So that's why you have to keep on practicing this concept. Like each and everything that I'm teaching you right now, after the lesson, you have to check the market and then try to identify this thing on your own and then Send me examples so that I can approve that indeed you are understanding the concept, right?
Okay.
Yeah. So that's how you identify the trend, the uptrend, and then the downtrend. Now, after identifying the trend, the next concept is, after identifying the trend, the next concept is change of character and break of megastructure. The next concept is change of character and break of megastructure. Now, let's say we have this scenario. Let's say we have the price, which is in uptrend, whereby the price is creating higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. And then we have this megastructure shift, and then the price starts to sell, and then up, 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 up. Yeah. So when you look at this price, on the first step, the price is bullish. On the second leg, the price is bearish. And then on the third leg, the price is bullish. So that's how the market moves. The market cannot move in a straight line. So when the price is bullish, at some point, the price is going to be bearish. At some point, the price is going to be bullish. So you have to understand that we have the concept of change of character. You have the concept of change of character, and then we have the concept of break of megastructure. So that's how you differentiate that how indeed price is bullish or the price is bullish or is bearish. Now, when the price is bullish, you will see price creating higher highs, and then higher low, and then higher high, and then higher low, higher high, higher low. Now, let's look at the bullish price. So in the bullish price, we see price creating a higher high, and then after creating a higher low. Now, after creating this higher low, we see the price moving up aggressively. Now, when the price moves up aggressively, what happens to this high?
It's a structure break.
Yeah.
Breaking the structure.
It broke the structure. So we have break of megastructure here. So that's BOS. This is what we call break of megastructure. Now the price has just created this new high and then this low. From this low, we see the price pushing up aggressively, and then we have break of megastructure. Now, after breaking this megastructure, the price creates another new structure here. After creating this new megastructure, creates another low. From this low, the price pushes up aggressively again, and then it breaks this high. Now, when the price is bullish, the price is only breaking the highs, and the lows, they are left untouched. The lows, they are left untouched. So when the price is bullish, the price is only breaking the highs, and then the lows are left untouched. As you can see, the price breaking the highs, and then the price breaking the highs, and then the price is breaking the highs. That's how you differentiate between uptrend and downtrend. When the price is in uptrend, it is only breaking the highs. And then when the price is in downtrend, it is only breaking the lows. Now, to know that the price is changing from uptrend, downtrend, there's to be what you call change of character. Change of character, it shows that the price is changing direction. If the price is bullish, then we see price breaking the low. That's change of character. From uptrend to downtrend, that's change of character. As you can see that when the price is bullish, the price is only breaking the highs. Now, when the price starts to break the lows, that's change of character. You get it?
Okay.
Yeah, yes. That's change of character. And then after change of character, this is what you call break of megastructure towards the downside. And then we have break of megastructure again, break of megastructure, and then we have break of megastructure. Now the question is, what is this?
It's a change of character.
Change of character, because the price from downtrend now is entering into uptrend. Now from downtrend, and then we have change of character here. Now what is this?
It's a break of structure.
Yeah, break of structure, and then we have break of megastructure again, and then we have break of megastructure. So that's how you read the structure of the market. Firstly, you have to start with the trend, identify the trend, and then after identifying the trend, know about the concept of break of market structure, know that when the price is bullish, the price is breaking the market structure towards the upside. And when the price is bearish, the price is breaking the market structure towards downside. And know that between the uptrend and the downtrend, between the uptrend and the downtrend, there's to be change of character. And between the downtrend and uptrend, there's to be change of character again. Now, let's get into the market and look for this, for what you're talking about right now. So let's look at gold. Let's look at gold in daily time frame. Now, when you look at gold in daily time frame, you can see that, let's say, for example, we use this path from here to here. What's the trend?
That is uptrend.
That's uptrend. So we can see that here, gold was on uptrend and the price was creating a series of higher highs and then higher low, and then we have the higher high. Now, from this high, we see the price moving up aggressively, and then it takes out this high. Now we have break of market structure here. Now, the break of market structure, the price creates another new high, and then it creates another new low. Now, look at this low. When the price creates another at this low, it didn't break the previous low. Why? Because we said when the price is bullish, the price is only breaking the highs, and the lows are left untouched. Now, from this low here, the price moves up aggressive, and then it takes out this high. And then it continues to take out the highs. So that's how the price moves when the price is bullish. And then after taking out this high, we see the price creating another new high. We see the price creating another new high. So we have this high here. And then from this high, the price retraces to create this new low. Now, what was your prediction? Let's say, for example, the price was from this low here, and then what can you predict? If we are from this low looking at the previous market structure, we can predict that the price is going to,
it's going to make a new high.
It's going to make another new high.
According to the prediction.
So according to your prediction is that the price was going to make another higher high, because as we can see that the price was breaking the high, and the same thing we're going to predict that the price was going to make another new high. But because we don't control the market, the price dropped towards downside, and then we had what you call change of character. Now the price started to break the lows. Instead of breaking the price chose to break a low. Now we have change of character here, and after change of character, we have break of market structure towards the downside, and then we have break of market structure again towards downside. Now and then when you look at the structure that we have here, we have a lower low, and then from this lower low, we have a lower high. From this lower high, what was your prediction? What were you going to predict from this lower high?
It's going to make a lower low again.
The price will make a lower low again. And then the same thing, we see the price failing to make another lower low, and then the price just created an area of support, and then it pushed up aggressively. Now, what is this?
It's a higher high. Oh, actually, a change of character.
Yeah, that's change of character. So after change of character, we know that we are looking for buying opportunity, and remember which highs to choose. You choose the mainly you choose the main highs, not the inner ones. So that's break of market structure, and then break of market structure. And still today, we are looking for gold to push so that it can break this high, so that we can continue with our trend. So that's how you read the structure of the market. That's how you read the structure of the market. Right now, we know that gold is bullish. And we know that if the price is bullish, we focus on the buying opportunities. So we are focusing on the buying opportunities of gold because the price is bullish. Now, the third concept is what we call expansion and retracement. We did talk about the trend. We talked about change of character and break of market structure. Now, the third concept is expansion and retracement. Now, keep this in mind. The price cannot move in a straight line. At first, I illustrated that when the price is bullish, the price is creating higher highs, higher low, higher high, higher low, higher high, higher low, higher high. But in reality, the price cannot move in a straight line. So that's why I introduced the concept of expansion and retracement, so that I can show you the reality of the forex market. So the forex market moves to what you call expansion and retracement, which means if the price is bullish, the price will expand up, and then it will retrace towards the downside. When the price moves up, the price will expand, and then when it sells, the price retraces. So that's how the price moves.